everyone. Tom Dixon here, your host of the Financial Experts Network, and delighted you can join us for a special session on very important topics around taxes and all of the issues that are now being brought to bear because of the Build Back Better plan that was first proposed on September 13th in the House and Ways Committee. And wow, does it have implications really for many people, including middle America, small business owners, and the like. So it's not just the wealthy that could be impacted by this plan. So I'm delighted to have join us one of our many experts that we're fortunate to have join us on the Financial Experts Network, and that's CPA Scott Bishop, to discuss some of the provisions in the Build Back Better plan. Scott is a master elite edge slot advisor, as well as the executive director of Wealth Solutions for Avidian Wealth Management. So really delighted, Scott, to have you here to join us. So thank you so much for taking the time.
Happy to be on, Tom.
Great. Now, as always, folks, please, I encourage you to subscribe to our channel and, of course, click on that bell, ding, 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 to get notice of all upcoming posts and videos that we will make available. So delighted to have Scott join me again to talk about one of many aspects of the Build Back Better plan that could impact a lot of small business owners. And it's just, frankly, isn't just the wealthy, the super wealthy, but what's being proposed could impact small business owners that might have an S Corp, that might have LLCs, let alone C Corps. So, Scott, if you could you explain, again, what's being proposed and how it would impact a range of what I'll call middle America small business owners?
Absolutely. Well, the thing that people think about when they think of business owners, they typically think of big companies, regular corporations, where the corporation itself is a taxpayer. They call those C corporations. What happened with the Tax Cuts and Jobs Act that was passed in 2017 is that they cut the top corporate tax rate from 35% down to 21%. Many Democrats thought that was too much and they wanted to raise it back to the prior levels. But in terms of the negotiations where they're at right now, is those corporate taxes are most likely going to be going up from 21% to possibly the level that they're talking about now if your income at the business is more than $5 million to 26.5%. So some people that may have converted a company to a C Corp to get those lower rates, they're going to have to take a look at that again. Typically, C corporations are not the typical companies we see today in business. Typically, we see pass-throughs, LLCs, S Corps, partnerships, but the C Corps are seeing their tax rates go from 21% to 26.5%. For those other business owners that use the S Corps, the LLCs, the partnerships, is that the entity itself is not a taxpayer. The business owner may take income from the company like wages and salaries, but typically any profits from those companies go down to the owners via K-1 onto their personal tax return. So those are what's called pass-throughs. One of the other things that those business owners had, many, not all business owners, don't want to go into the details of that, but a lot of those business owners that have pass-throughs, since they weren't going to get the benefit of the 21% tax rate, they updated code section 199A to give them a 20% pass-through deduction on that income that would pass through onto their tax return. That will be going away based on this law. As for anybody earning more than $400,000 or $500,000 a year, those types of deductions, which was a nice 20% deduction. So if you had $1 million pass-through before and you're an eligible business, you're only having to report $800,000 on your tax return. That's the 20% reduction in income that was subject to tax. For many people, that's going to be going away. For medium-sized business, again, this Build Back Better plan was supposed to go after the super wealthy to make them pay their fair share. But what this is saying, if you're making over $400,000 or $500,000, that is going to be reducing. I would say, Tom, that's wealthy, but I wouldn't call that super wealthy, because they always talk about Warren Buffett, Bezos with Amazon, Peter Thiel, who had the $5 billion Roth IRA. Those are the super wealthy, but this is going to hit middle America business owners, and it's going to increase their taxes. Tom, the other thing that's really going to be hitting them is if you remember with Obamacare, they actually introduced something called the net investment income tax that was supposed to be on investments with people with passive income. For people of a certain income, they actually had to pay a 3.8% net investment income tax. That was added on to capital gains or dividend taxes they were paying. With this new law, they're going to be adding that 3.8% net investment income tax even to people that are managing an operating business. So the business owners with pass-throughs, they're going to be losing the income, the deduction for the 199A, but also for distributions have to pay that additional 3.8% tax on that. Just as an idea, just to kind of share this with you, if you're a good-sized business owner with a successful business, and let's say you live in California, because everything we've talked about so far has not included state income tax, you may pay as a business owner with a pass-through, the top income tax rate's going to be 39.6%, plus possibly that 3.8% net investment income tax. Plus, if your income's over $5 million, you're going to pay a 3% surtax. And if you live in California at those levels, you're going to pay a 13.3% California state income tax. That means for those business owners, Tom, they're going to be paying, I guess, what they consider their quote fair share, a 59.7% income tax when you just consider federal income tax and state income tax. And that doesn't account for property tax, sales tax, and things like that. That's a pretty big amount. So for people like that, what they're going to have to do for at least the near term between now and year end, these rates don't take effect until 1/1/2022. So what you may want to figure out is where we usually like to defer income and accelerate deductions. This may be the year 2021 where we want to accelerate income at lower rates and not pay these additional taxes, and defer deductions until next year when these tax rates may be higher. The one place with business owners that they didn't increase their taxes on, Tom, are the people that tend to be the billionaires. You know, the tax carried interest, those are typically done on partnerships with an investment construct, many times real estate and things like that. For people that are allowing other investors to be limited partners, many of these owners keep a carried interest as part of their compensation. Historically, they pay capital gains rates on that, so that will be going up a little bit. But those people, they were talking about taking away that carried interest deduction for that income and make it subject to ordinary income tax. This legislation did not materially impact carried interest. So people that have these big hedge funds are still going to be able to pay capital gains rates on a big part of their income. So Warren Buffett may still have a lower tax rate than his secretary.
Wow. Okay. All right. Great. So, but you made a good point here for small business owners that may, again, may be subject to these new rates and basically paying more income. The thing to be, among other things to be thinking about now is to possibly accelerate your income in 2021, excuse me, and then defer deductions, and they might be doing something with the deductions from what I've read with SALT, and they may expand that, which again, who knows, but at a minimum, you should think, you should be thinking about pushing any income you have into this year, given the risk that, again, rates may go up in 2022. Okay, any other ideas for the small business owner? Scott, as I'm listening to this, I'm almost thinking, you know, the type of corporate entity that you use, should you kind of step back and rethink that, given these tax proposals? Would there be a benefit to perhaps a different structure?
I would think now is probably not the time to do it. Let's let these laws pass. If they do pass, let's let the ink dry on those. And most likely sometime by the middle or end of next year, me and you, Tom, and hopefully other people are going to be talking about these things, and really bright minds are going to be getting together and trying to find a way to optimize this new tax regime and figure out the best way to try to take lemons and make lemonade out of it. So I would not go ahead and do that. I think it's very much worthwhile looking at it, because who knows if this legislation will impose restrictions to not allow for those types of changes if it's beneficial. So don't make any big changes, especially changes that could cause taxation. Changing from one entity to another is not always without taxation. So be very careful on making those changes and take a look at what the years to come have to be. Because we want to make sure you're not doing it causing some kind of tax now and only have a minimal benefit. Because even with the C corporation, where there are those lower taxes, don't forget, that's where you have the double taxation. Because when you take something as a C corporation, other than income as wages, you have to pay taxes on the distributions as dividends. So it's not always that easy, but it's really important to have smart advisors around you.
Yeah. Okay. Great point. Okay. Great. All right, Scott. Well, thank you so much again for sharing your insights on this really important issue. And again, I'd encourage any small business owner, as Scott often does as well, make sure you're consulting with your trusted advisors, whether it's your CPA, your financial planner, and the like. And you really need to stay abreast of what's been proposed. But once it's in the works like this, if they can work it through reconciliation, there's a likelihood that this may come to pass. So with that, again, I hope you find this to be valuable, and again, take advantage of the other videos that we're making available as well.